Environmental, social and corporate governance, ESG. 5. Responsible investment 2. Institutional investors. One of the defining hallmarks of the modern investment market is the divergence in the relationship between companies and their equity investors. Institutional investors have become the major owners of stocks, from 35% in 1981 to 58% in 2002 in the US, and from 42% in 1963 to 84.7% in 2004 in the UK. Insurance companies, mutual funds and pension funds with long-term payment obligations, compared to individual investors seeking short-term yield, more interested in the long-term sustainability of their investments. Where pension funds are subject to ERISA, there are legal limits to the extent to which investment decisions can be based on factors other than maximizing the economic returns to plan participants. Based on the belief that addressing ESG issues will protect and enhance portfolio returns, responsible investment is fast becoming a mainstream concern in the institutional industry. By the end of 2016, more than a third of institutional investors, commonly referred to as LPs, in Europe and Asia-Pacific said that ESG considerations played a significant or major role in denying investment to private equity funds, while the LP in North America is only 1/5. In response to investor interest in ESG, private equity and other industry trade associations have developed a number of ESG best practices, including a due diligence questionnaire for private equity managers and other asset managers to use before investing in portfolio companies. Curbing climate change. A network of institutional investors working to curb climate change has emerged. Among them, institutional investors agreed to take responsibility for climate action goals. One such example is the Climate Change Institutional Investor Group, looking to deliver significant progress to net zero by 2030. In addition, these networks are working with investment frameworks to assess companies' progress towards net zero emissions. One such framework is Climate Action 100+, a set of criteria used to assess companies with the largest greenhouse gas emissions. Principles for responsible investment. The principles of the Responsible Investment Initiative, PRI, were developed in 2005 by the UN Environment Programme Finance Initiative and the UN Global Compact as a framework for improving ESG issue analysis in the investment process and helping companies exercise responsible ownership. As of April 2019, there were more than 2,350 PRI signatories. Equator Principles. The Equator Principles are a risk management framework adopted by financial institutions to identify, assess and manage environmental and social risks in project financing. It is primarily designed to provide minimum standards for due diligence to support responsible risk decision-making. As of October 2019, 97 adopting financial institutions in 37 countries have officially adopted the Equator Principles. Most international project finance debt in emerging and developed markets. Equator Principles financial institutions, EPFIs, undertake not to lend to projects for which borrowers will not or cannot comply with their respective social and environmental policies and procedures.